Hey, good morning, everybody. In Accounting 230, we're up to Chapter 11, and we're going to talk about raising money with stock issues, paying dividends, buying back stock from the public if we wish to do that. In Chapters 9 and 8, mostly 9, we learned about how companies can raise a lot of money, big money, with a bond issue. They announced to the public that they want to borrow $10 million and explain why they want to borrow it, what they're going to do with the money, and offer what they hope is a competitive interest rate. And issuing bonds has advantages and disadvantages. This chapter here, we're going to talk about raising money by issuing stock. Issuing stock has advantages and disadvantages, but it's one of two ways where companies can make a lot of capital come into their hands pretty quickly, huh? So let me get into our chapter here. Chapter 11, we're off to a good start. Let me set this up. Let me do my Sheldon Cooper thing here. There we go. All right, chapter 11. They talk a little bit here on this first slide about the advantages of a corporation. Easy to become an owner. All you have to do is buy one share of stock and you're an owner of IBM. Easy to transfer ownership. You buy a share, you buy 10 shares of IBM stock today for 100, and maybe in a month or so, you sell it for 105 to somebody else. Takes a split second. Easy to become an owner and get rid of your ownership if you wish to. And as far as the corporation is concerned, they have what's called used to call it the corporate shield. It's not quite the shield it used to be. It provides limited liability to the employees, the officers of the company, if you will. If they screw everything up and the company loses money, you can't come after them personally like you can with a sole proprietorship or a partnership. So corporation, it's a separate legal entity. It can own assets. It can incur liabilities. Excuse me. Let me just bring that. I get a little problem on my end. Yeah, they can own assets and they can incur liabilities. They can be sued and they can sue themselves, enter into contract. So it's a separate entity unto itself, okay? Let me just get going here. Ownership of a company, huh? You buy stock in a company. You buy common stock. Well, common stock has certain rights. You have the right to vote at the annual shareholders meetings or in any other initiatives that might come up. You're entitled possibly to a proportionate distribution of the profits in the form of dividends, and you may get a certain amount out of any liquidation. Hopefully it doesn't come to a bankruptcy, because that's what we mean with a liquidation, where you're selling everything. So there's some rights of a corporation. They're talking about in person or by proxy. Every year, major companies, corporations have their annual meeting for the public where they talk about the results of the last year, they talk about the future, and they have a question and answer session. If you have just one share of stock, you can show up at that meeting and possibly work your way up to the microphone and ask a question. Most people don't do that with just one share of stock, and that can take a couple of days off from work to travel maybe across the country. So you vote by proxy. You will get in the mail a voting ballot. You can fill it out. And I must confess that I don't always do that. So they vote by proxy, meaning they will vote the way they want to using my ballot. Ownership of a corporation. Stockholders are the owners of the corporation. And we have a board of directors. Board of directors, they're the ones who are going to decide who and when a dividend is going to be paid. The board of directors is it's a group of internal people, probably the vice president of finance and other officers, and external, very well educated people from other companies. And the shareholders, you and me, we elect the board of directors, and the board of directors hires the management. So the board of directors is a powerful, powerful unit within a corporation. They will make a lot of decisions. Okay. Let's start looking at issuing stock to the public. Authorized shares, issued shares, and outstanding shares. These are terms we must know very clearly, so let's start looking at them. Authorized shares are the maximum number of shares of a stock that can be sold to the public. A company decides it wants to raise millions and millions of dollars by issuing stock. They'll prepare a prospectus, and the state will say to them, you can only issue, say, 1 million shares of stock. Once they issue 1 million shares of stock, they have nothing left to issue. Authorized shares, the maximum number of shares that can be sold. Once the shares are issued or sold to the public, a first-time sale of stock to the public like this, initial public offering, let's use the word they issued the shares. After that, as the shares change hands, they're sold. Here, we're selling them. We're also calling it issued shares. So here it looks like this company issued half of the shares. Half of the shares. The rest are unissued. Unissued. So authorized shares, the most you can sell, and we have issued shares and then outstanding shares. The outstanding shares are these 50% that have been sold. Outstanding shares, we're talking about what's owned by the public. So we'll take a peek here. We're still talking about these terms. Here is our circle here, okay? There's our pizza pie, and that's 1 million shares, say. Well, what happened here? We know they issued 50% of the shares. They just told us that. They issued 50% of the shares, which means that unissued 50%. But look what happened to here. They purchased back something called treasury shares, treasury stock, treasury shares, issued shares that have been reacquired by the corporation. Treasury stock has a specific accounting process we're going to go through. A company can buy back its own stock from the open market. IBM issued shares at $100 a share, and the price went down to, say, 90. And IBM thinks that, boy, that's a good investment. We think our stock's worth more than that. So they go out and they buy it back from you and me. Those are called treasury shares. Earnings per share, this will be on your next FSA. Income divided by the outstanding shares. Income divided by the outstanding shares. And they're doing a little editorializing here, I guess. Earnings per share is probably the single most widely watched financial ratio. It might be. And here we go. Sonic's income for 2010 was $100,100. And the average shares outstanding is the same number. So that's not too hard to figure. That's not too hard to figure, huh? Let me go back up here. I'm sorry, I got the happy fingers going again. So there's our calculation. $100,100 over 110,000 shares, 91 cents per share net income. You, as a common stockholder, might start thinking, well, that's almost $1 they could give me in the form of a dividend. They might not. And they're just showing you some comparisons to other companies. Other companies. This thing is giving me a hard time here. So sorry, guys. Get out of there. Okay, you're looking at Sonics over time. 2008, they earned 65 cents a share, and then it went up to 78. That's about a 20%. That's a 20% increase, more than 20%. And here it went up another 10% or so, maybe 15% to 91 cents. So Sonics is in the fast food business, right? The good food available quickly business, okay? So what they're saying is, well, let's look at this 91 cents a share and see how Sonics compares to some of the big boys. Well, Sonic is nowhere near Jack in the Box. Look at Jack in the Box. They earned $3.34 per share. And Wendy's is close to Sonic, $1.10. Earnings per share. Net income divided by the outstanding shares. The outstanding shares. Okay. All right, let's talk about common stock. We're going to talk about common stock, preferred stock. Common stock is the basic ownership stock of the company. It gives you voting rights. It may or may not provide a dividend to you. And it's the most common stock you can buy. Maybe that's why they call it common stock. Preferred stock, we'll get to in a moment, is a totally different investment. So you buy stock in a company, you're going to be buying common stock. If you set yourself up today at a stockbroker's or a bank or someplace where they allow you to trade stocks, if you said, I want to buy 100 shares of Coca-Cola, that broker, whoever he or she is not going to ask you, are you buying common stock or preferred stock? They're going to assume you're buying common stock. Common stock. Preferred stock, again, is more like a bond, and we'll get to that in a second. And who sets the dividend? The board of directors. The old cliche back in the 60s, the 50s, of these old white guys coming out smoking all the cigars, and they make a big deal that they're issuing a dividend of 10 cents a share or something. Once they announce that dividend, they have to pay it. Otherwise, companies never have to pay a dividend, and that includes preferred stock, even though the only reason you buy a preferred stock is to collect a dividend. Par value. This is par value is a nominal value, like you see their legal capital. It's a meaningless number. It is a number required by states under different circumstances. Par value has nothing to do with what the stock is worth. If you bought a share of a company today and the par value was 100, and I bought a similar amount in another company and the par value was a penny, does that mean that the higher par value has more upside? Absolutely not. It's just a required number. It can be a penny, it can be a dime, and companies can kind of choose what they want to do. Some companies, they could put a penny up there, par value penny, and then when they issue the stock to the public, maybe they get $30 per share in the IPO. Then they can say, wow, look at this. We got 3,000 times more than par value. It's a foolish, meaningless statistic, but it can impress people. The only thing you are going to do with par value, homework-wise, test-wise, is you're going to take the par value and you're going to multiply it by the number of shares involved in the transaction, and that's going to be your common stock number. Your common stock number. Outstanding shares times the par value will equal the account called common stock on your balance sheet in the stockholders' equity section. Par value has nothing to do with market value. Just like a depreciated asset has nothing to do with its real market value, okay? Some states don't require a par value to be stated in the charter. Big deal, okay? Par value, nominal, meaningless number that always must equal a multiple of the shares times the par value. Well, we're in a big corporation now, and we've decided we don't want to borrow money, but we need to raise millions with a stock issue. We've decided a stock issue. We prepared a pamphlet, a little tiny magazine called the Prospectus. The Prospectus talks about why we're trying to issue stock to the public, what we're going to do with this money. We're going to issue our financial statements and forecasts, and investors can decide whether they think our company is worth an investment. So we are now going to work with 3 accounts within equity, and you've seen them all. You've seen these all. Your equity section basically comes down to two areas: contributed capital. Contributed capital. Early in the course, that's where a man or a woman opened up a company with their own money and they put $50,000 into a business. That's called contributed capital. Well, we can also raise money without taking it out of our pocket by issuing stock. So this is also contributed capital. So we issue one share of stock with a par value of $1, and the IPO gives us $20. Well, our journal entry, we should know, is going to be a debit to cash for $20. One share times $1 par value is credited to this equity account, and any cash in excess of that par value, that is called capital in excess of par value. Paid in capital in excess of par value is what we used to call it. Issuance of stock, okay? What they're talking about here is initial public offering. This is the first time a corporation sells stock to the public. Remember I said the IPO comes into being. The shares that are originally sold to investors from the corporation, that's called an issue. The first time you sell it, we're going to call it an issue. And then subsequent shares of new stock would be a season, what they call a season new issue. So we're issuing shares. Any shares that the company has authorized, those are issued shares when they go out to the public. Just at one time, we're going to use the word issued. All right, let's see what happens here. Let's go through some journal entries. Sonic issued 100,000 shares of 1 cent par value common stock for $20 a share. Do we care about that 0.01, that penny per share? No, it has nothing to do with analyzing the investment. What we should know, though, is we're going to take 100,000 times 0.01, and that's going to be the common stock portion of our contributed capital. So let's go back. They're giving us a blank journal entry. Well, 100,000 shares times a penny, I guess that's $1,000. If I did that right in my head, let's see. Wow, look at this. Sonic issued 100,000 shares at a penny a share. The only thing you do with the par value, multiply it by the shares, and that becomes your credit to common stock. The cash we brought in, $20 per share. So we were able to sell these shares for $2 million. The difference between the cash and the capital in excess of par, and the common stock rather, is your capital in excess of par. Okay. Now this we've seen earlier in the course, and I'm thinking this is not going to be too tough. Okay. The secondary market, transactions between two investors that don't affect the corporate's accounting records. And it's very simple. It's just like you see here. You are in the secondary market. Stocks are in the secondary market once they're issued to the public. That's what the outstanding shares are, the secondary public. That's me on the left. I bought some Sonic stock a couple of years ago. I call my stockbroker, and he found this guy who wants to buy my stock for what I'm willing to sell it for. Secondary market. The trades between the public do not affect the corporation's accounting records. If I bought stock from Sonic at $20 a share and I sold them a year later for $50 a share, that's my profit. It has nothing to do with the company, other than the company likes seeing its stock price rise. Here we're going to get into something. I just want to skip ahead here 1 second. There we go. Here we go. Here we go. Stock issued for employee compensation. A lot of times, employee compensation packages include salaries and maybe stock options. Stock options, or maybe just stock. If Sonic does not have enough unauthorized shares when the stock options are issued, they have a problem. They have a problem. They promised employees that at the end of the year, they would get so many shares of stock as a bonus. But Sonic no longer has enough shares to issue. So what we're going to have to do here is we're going to have Sonic buy back their shares from the public. And that's called treasury stock. And we're going to talk about that in a moment. Let's just talk about stock options briefly. A stock option is a very nice thing to receive. Stock options allow employees to purchase stock from the company at a predetermined fixed price. The way it works is this: you work for a company like IBM, and part of your package with the company is you are given 1,000 stock options. And those stock options say that you can buy that stock anytime you want at $50 a share. No matter what the stock is selling for, you can buy it for $50 a share. Well, when they gave you that option to buy the stock for $50, the stock was only at $35 a share. So you're not going to use those options to buy stock for $50 when it's on the market for $35. But hopefully over next year or two or whatever, that stock price goes above 50. Maybe it goes up to 90. Well, then you might strike your options, meaning that you can buy that $90 stock for 50 and lock in a $40 premium or profit if you want to sell right away. Stock options are good motivators, many managers believe. If you issue stock options to your employees, hopefully that's going to spur them to work hard and do everything they can to get a shot at these stock options and at the same time enhance the company's value. We're all familiar with Home Depot, right? Everybody in the world goes up there at one time or another. When Home Depot first came aboard, they were in all kinds of trouble. For a while there, it looked like Home Depot would not succeed. And it got to the point where they couldn't pay a lot of the employees. What they did, though, they offered employees options like this. They offered them shares of stock. And the early employees who accepted that in lieu of a salary did very, very well. Okay, now we're talking something called treasury stock. Treasury stock. This company, Sonic, wants to repurchase its stock from its employees. Not from its employees, from the secondary market. From the secondary market. Once the stock has been issued to the public, if the company wants to get those shares back, they have to buy them just like you and me would. So they want to buy some of their shares back. And one reason might be to fulfill these stock option obligations, okay? That's one reason. That's a reason I particularly don't care for. I'm going to get into a little bit of politics here. When a company repurchases a stock, it can be a good or bad thing, possibly, for the other shareholders. If a company is buying back its own stock because they feel that the stock is undervalued at, say, $40 a share, and all their forecasts are for good news in the future, this company doesn't understand why that stock is sitting there at 40. They might go out and buy 1 million shares at $40 in the hope of selling it back again someday for a profit. That's called treasury stock. That's the good reason. If a company buys its own stock back for that reason, it looks like they're optimistic about the future. But the one that really irks me and other people, when companies are forced to buy back their own shares from the secondary market to give out salaries and stock options. That does no good for anybody. It doesn't reference the value of the company. It's just a requirement that they fell into to fill these stock options. Treasury stock. Treasury stock. When it's reacquired, the corporation records the treasury stock at cost. Okay. Treasury stock has no voting or dividend rights. And this is important. Treasury stock is not an asset. Treasury stock is not an asset. In fact, when you buy treasury stock, it is a contra equity account. When you bought your own shares back, you reduced the capital of your company. And let's try to get a feel for that, okay? Treasury stock has no voting rights or dividend right. It's not an asset because companies are not allowed to show profits from buying and selling its own stock. That would be a horrible conflict of interest. And it would just set up all kinds of fraud, all kinds of illegalities. A company cannot buy back its own stock and put it on the balance sheet as an outside investment. You can't do that. When you see that line, investment, short term or long term, those are with independent companies other than your own company. Treasury stock is not an asset. It is a reduction in your equity. So let's see what we have here. They reacquired 100,000 shares at $20 per share. $20 per share. Well, that's pretty easy. They got 100,000 shares times 20, 2 million. Cash went down 2 million. And equity also went down by 2 million. If you put that 2 million bucks on the balance sheet as an asset, that would be horribly misleading. That would be telling the world that if worse came to worse, you could sell those 2 million shares independently. Not correct. Treasury stock. Well, we bought 100,000, I guess it was, for 20. Now we're selling some of them back to the public. Reissued. Use the word reissued. They're really selling them in the secondary market. The word issue should be reserved for the initial public offering, but that's okay. So Sonic sold 10,000 of the shares back at $30. Okay, so that's going to bring in $300,000, right? 10,000 shares times 30. What did we pay for these things? $20 a share. So that's how much we will reduce the account called treasury stock, and the difference goes into capital in excess of par. Now you see the equity increasing by $300,000. $300,000. This $300,000 in cash covered the 200,000. So we have this, I'm going to use the word profit just briefly. Yeah, we made $100,000, but is that going to be called a profit? No, it's not called a profit. You can't make money buying and selling your own stock. That's not what the business is intended to do. And it's got all kinds of legal and ethical ramifications, okay? So any profit or loss from selling treasury shares back to the secondary market, that profit's going to go into capital in excess of par. Paid in capital in excess of par. Treasury stock. Stocks can pay dividends. I bet you knew that, huh? Stocks can pay dividends. The dividend is declared by the board of directors. That's important to know. It's the board of directors who decide what the dividend payment will be and when it will take place and how many shares. It's not legally required. It's not like a bond. Remember in chapter 9 and 10 with the bonds, if you don't pay your bonds holders interest, they'll come after you immediately because that's a legal requirement. It's part of the bond covenant. Here, investors go in knowing that they may never get a dividend because companies don't have to pay them. A company can only pay a dividend if they have enough retained earnings in cash, okay? Kind of like you and me. You know, we can't buy something without having the money in the first place. The dividend must be paid at the declaration date. The declaration date. The board of directors issues a press release or an announcement. They say, we're pleased to announce a dividend of $1 per share for 100,000 shares of stock, outstanding share, okay? All dividends are debited to this account, retained earnings. No matter the type of dividend. This is a cash dividend. In a moment, we're going to go over stock dividends. Any dividend, no matter what the category, is debited to retained earnings, and you set that liability account up called dividends payable. Okay, so here they're just making the announcement. Once they announce it, they can't take it back. They have to pay that dividend. Dividend dates that we need to understand. Well, we just learned about the declaration date. The declaration date, meaning the announced date, that creates the liability. The payment date is going to be the time when we cut the check. One other key date here, date of record. Stockholders who own the shares on this particular date will receive the dividend. No entry needed there, not an accounting entry. In other words, this dividend, did they give us a date when the dividend was declared? Yes, they declared the dividend on March 3rd, and it's to be paid, we just found out here, on April 20. On April 20. So who gets this dividend? The dividend will go to the people who own the stock on the date of record. That might have been April 1st. At the end of the day, you're going to run a report showing who owned how many shares, and those are the people who get the stock. If you bought the stock 50 years ago, but you sold it before the dividend date, you don't get the dividend. The person who bought that stock at 4 p.m. collects the dividend and then can sell the stock the next morning and repeat that process. And it used to be thought that investors, knowing that there's a dividend payment date coming up, that it might attract some attention, attract some unusual buying, and the stock might take a little bit of a rise. But I think those days are over. People kind of know, are pretty savvy to the dividend dates and the date of record. But if you own the stock at the end of, say, April 1st, you get the dividends. Ex-dividend date is a workaround of, in this case, they're talking about 2 days prior to the date of record. There's a little bit of a range in there. But we're mainly going to talk about the date of record as being a firm line in the sand. Stock dividends. Oh, stock dividends. Distribution of additional shares of stock to the owners. I used to love getting stock dividends. I still do. I haven't gotten any in a long time. Stock dividends. Look at this, though. No change in the equity. Nothing changed in the equity. No change in the par value. And all shareholders retain the same percentage ownership. And very simply, what this means is you owned 100 shares of stock at $1 a share. They give you a 100% stock dividend. You now own 200 shares, but the market value's been cut in half to 50 cents. So there's no impact accounting-wise with a stock dividend other than the journal entry to debit retained earnings and credit capital. Now, having said that, why would companies do this if it makes no difference? Part of it is psychological, I think. I'll give you a great example. Apple. Apple was out of business almost 20 years ago, maybe not even that far back. Steve Jobs came back to the company after he was pushed out, and he developed a couple of products that work out pretty good, called the iPhone and the iPad and these different things. And that stock started to go from a low of about $6 a share, if you can imagine that. And it just kept going up and up and up, and people were buying and buying and buying, and it kept rising and rising. It eventually went up to over $700 a share. And at that point, Apple issued a 7-for-1 stock dividend. In other words, if you owned one share on that day for, say, $1,400 a share, say $700 a share. At the end of the day, you owned 7 shares at $100 a share. No difference. But why do companies do this? Again, psychological, I think. You are an average investor or a small investor, and you see a stock selling for $700 a share, and you say, "Oh, that's way out of my league. I can't afford to buy that. $700 a share. I can only buy maybe 1 share." But if the stock comes down to $100 a share, it looks more attractive, even though the value to the investor is the same. So companies issue these stock dividends partly in the hope that the lower stock price will increase traffic. People will start buying and buying, and then the price can start to go up again. You have what's called a large dividend, stock dividend, and a small one. A stock dividend over 20-25%. Yeah, you're going to work with excuse me, let me just move this out of my way. Wait. I can't understand why this thing drives me nuts. Yeah, a stock dividend, what's called a large stock dividend, you just record it at par value. It's a 2-line journal entry. If it's a small dividend, forgive me, guys. If it's a small dividend, you have to put it in, you have to use the par value and the capital in excess of par, paid in capital. And we'll talk about that a little more. Let's take a look at what happens with a stock dividend. A stock dividend. The current stockholders' equity is shown. And look at this. They've got preferred stock and they've got common stock, 100,000 shares at a penny. These are all dollars. And then they have $1,999,000. So that's $2 million in common stock that they issued. They have retained earnings. That's nice to see. So the total equity in this company at the end of, at this point in time anyway, is $3 million. So what happens here? Sonic says we're going to give out, excuse me, a 10% stock dividend. 10% stock dividend when the market price is $15 a share. $15 a share. So 10% times the outstanding shares, you see it up here, of 100,000 times 15 is what they're saying is going to be capitalized. That's going to be the amount of the stock dividend. So the 150,000 will be distributed between, because this is a small stock dividend, just 10%. Here, you're going to have to write a journal entry to debit retained earnings for that amount, and then credit the par value and put the difference of $1 versus 15 into paid in capital in excess of par. But let me get to the main point, huh? What was the stockholders' equity before the stock dividend? $3 million. What was it after the stock dividend? $3 million. What changed? Well, we had to reduce our retained earnings. Remember, we said that any dividend, no matter cash or stock, is always going to reduce your retained earnings, which is a capital account carrying a credit balance. So that went down 150, and here's the difference here, the 150 with the 1,100 in common stock. That was 15,000 shares times 0.01, and the difference goes to paid in capital. How about a stock split, huh? A stock split. You as the investor, you're sitting at home and you get a letter from the company and telling you that that 1 share you own for $100, you now have 2 shares worth 50. You look at that letter and you say, okay, that's fine. I'm happy with that. You are not going to know whether it was a stock dividend or a stock splits. But as far as the company is concerned, a stock dividend changes your capital categories. You're going to have to debit retained earnings and credit capital, or possibly common stock, and then maybe paid in capital. Excuse me. God almighty, this thing is jumping all over the place. The key thing with the stock split is that there is no journal entry, nothing to do. A stock split is not an accounting transaction. And here's why. And just go through this slide when you're doing your homework so you might understand from a multiple choice question or two. I've never seen a test where they ask you to really do this because this is not an accounting department business. This is the corporation's board of directors deciding whether they want to issue a stock dividend or a stock split. And all we're saying here, everybody, is you have before the split 100,000 shares. We know that, right? After the split, there's 200,000 shares. The par value was $1, so that's $1,000. The par value here is still 1,000. What changed? What they did was they changed the par value. They changed the par value from a penny to half a penny. That's all they did. And I'm not sure what the strategic thinking might be, stock dividend versus stock split. I don't think it means anything really to the world. But what you need to know, stock split, no journal entry, no accounting transaction, because all the board of directors is going to do is change the corporate charter to move the par value in half. Stock dividends, stock splits. Preferred stock. Preferred stock. Like I said earlier, anybody calls a stockbroker and they say, hi there, Mr. Schwartz. Can you set me up with 1,000 shares of Coca-Cola, please? And he'll just ask you what price you're willing to sell it for. He is going to assume you're buying common stock. Common stock is the basic ownership of the company. It has the voting rights and a couple of other bells and whistles. Preferred stock is a totally different investment. Preferred stock, you have no voting rights. Preferred stock usually has a fixed, not usually, by definition, it has a fixed dividend rate. A preferred stock is almost like a bond, okay? Preferred stock has some advantages. If a company has a finite amount of money to pay dividends, no common stockholder can get a penny until the preferred people are paid first. So I guess that's why they call it preferred stock. Preferred stock. The preferred stock people will get the same dividend all the time as long as they own that stock. Preferred stock is almost like a bond. So let's take a look at a couple of things here. You buy preferred stock, and there are two different categories here that you really must understand. You have the current dividend preference. The current preferred dividends must be paid before any dividends to the common stockholders, okay? Any dividends to stockholders, to common stockholders, can't happen until you pay the preferred people. The problem with a current dividend preference is you will only get a dividend paid for the current year. If the company does not pay a dividend in 2019, 2020, and now they're paying in 2021, you're not going to get 3 years of dividends backed up. You're just going to get 1 year for this year. Cumulative dividend preference. Any unpaid dividends from prior years, those are called dividends in arrears, must be paid before common dividends are paid. So you own stock and the par value multiplies out to a dividend of $1,000 a year. Well, under the current preference, you're only going to get $1,000 at the most. Under the cumulative, if they have not paid dividends for, say, 3 years, they have to catch up to those 3 years, $1,000. If the preferred stock is non-cumulative, any dividends not declared. So the current dividend preference, really, we're talking about the non-cumulative. Any dividends not declared in prior years are lost forever. Let's take a look at Sonic. All of a sudden, we're working with Sonic. It was Chipotle all semester. Now Sonic. Common stock. Let's see what we have here. Well, we have this par value penny stock out. It is a penny stock. just realized that. Penny stock. Okay, 110,000 shares outstanding. That's our famous $1,100. Here, look at the preferred shares, though. Here's a preferred stock. The par value is 100. The par value on a preferred stock is important. On a common stock, it's meaningless because the par value of a preferred share multiply by the percentage that is on the stock certificate. This 3% will never change. It will never go up and down. When you buy this stock, one share of the stock for $100, you're agreeing, as long as you own the stock, that you're going to get paid $3 a year. These are cumulative. These are cumulative shares. Cumulative meaning accumulate, means to build up. Every year that they don't pay, they're adding to the prior year's, I don't want to say obligation, but possible dividend. Look at the preferred stock here, the non-cumulative, $50 par value. The dividend's a lot more, 6%. Still comes out to the same number, $3. Okay, so you have 2,000 shares of each. They didn't pay dividends last year. In the current year, the board of directors says we have $50,000 to spend. How much will each class of stock receive? Well, we know we don't even look at the common stock until we've paid the preferred people. So let's take a look here. We had 2 issues of stock, if you remember that, for preferred. We had the cumulative and the non-cumulative. And I'm going to skip to the middle here. Let's start with the non-cumulative. It pays a lot more, pays double. So 2,000 times 6% times 50, these people are going to get $6,000, but no more than that, because these are non-cumulative. This issue here, 3%, was cumulative. It means that these past years must be filled before you can get to a common stock dividend. So they didn't pay it last year. They had that arrearage there, dividends in arrears, 6. This year is 6. So that's $12,000 that must be paid to this class of stock before we talk about the common stock. Let's look at that non-cumulative again. They only get $6,000. So these people are getting $3 per share, $3 per share, and this is $3 per share. How much is left for the common stock? $32,000. Remember they told us that the outstanding shares were 110,000? Well, the current stock people only got 29 cents per share. There was only $32,000 left over after we paid the premium, not the premium, but the preferred stock dividends, preferred stock dividends. So if you're a common person, you only got 29 cents a share. Okay? That might not bother you, though, as a common stockholder. Because even though you're only getting 29 cents a share, a common stock has an upside that the preferreds don't. The preferreds don't. Common stock. You own stock in a company, common stock, and the stock is worth 29 cents a share at this point. But boy, they've developed some great products. They've got some real good sound thinking and management. The future looks great. Well, they come up with a couple of fancy inventions, and this stock price might go from 29 cents to $29. And now you've really made some big money as a common stockholder. You might ask, well, won't the same thing happen with the preferred shares? Won't their shares rise too? Absolutely not. Absolutely not. Because a preferred stock, you only buy a preferred stock to collect this dividend, this non-guaranteed dividend. If the price of the stock is jumping all over the place, it's not going to have an effect on this, because when you bought that stock, you agreed to take a 3% payment every year. So there's no real upside with a preferred stock in terms of capital gains. There certainly is with a current stock, common stock, not current stock, a common stock. And also, guess what? If companies are making a lot of money, you're going to earn a much bigger dividend than these 3% people. Why would people buy preferred stocks? Who buys preferred stocks? Well, I don't want to be politically incorrect, but just a little bit perhaps. Back in the 50s and 60s, did you know that women were not smart enough to handle money? Not true. But that was the thinking back then. It was awful. And what would happen is dad might pass away. The husband dies. And perhaps he left behind some money. And the poor wife, oh, she didn't know what to do with it. A banker or a stockbroker would tell her, put the money in a preferred stock. And what you have to, and what that'll do for you is provide you a steady stream of income. You never have to worry about it. Don't put it in common stock where you have to think and make decisions. And those are the kinds of people who buy preferred stock. People who are looking for just an income stream. Now, I'm an old guy, but I don't have any preferred stock. But that's a possibility for somebody like me. I'm collecting Social Security. I got my pension for I used to work. Maybe I should buy some preferred stocks, which will pay a strict stream of dividends to me. We used to. The term for an investment like a preferred stock or a real sound blue chip company like IBM or General Motors, they were called widows and orphan stocks. Widows and orphan stocks, meaning this is where you put your money to have a stream of income and keep it in a very safe place. Very conservative. I don't think any of our students would be interested in preferred stocks unless you're totally risk averse. Hey, guess what? You can't pay dividends if you don't have enough money. If you don't have enough money, enough retained earnings. And we're not going to go through the supplement right now. That is the end of the chapter. So I don't think this chapter is terribly difficult compared to the bonds, where you had to do a bit of thinking there. You notice there's no present value calculations to do. You'll get plenty of present value calculations when you get into accounting 240. But right now, we're pretty much done with present value other than the test coming up. So hopefully this was a useful exercise for you all. It's amazing. I didn't have one student show up for my class today. My goodness, you guys are doing pretty good too. So hopefully it's because you're looking at my videos and studying hard. Some of you are coming to tutoring regularly, and I know that can help. So anyway, off we go. And by the way, there's a news story that just popped up. Tiger Woods was in a terrible auto accident in Rancho Palo Verdes, California. And nobody knows at this point in time how the guy's doing. So say a little prayer for Mr. Eldrick Woods. Hey, you take care, everybody. Bye-bye.